So the CFA Society of Nebraska is very honored to introduce tonight's panel discussion, What Would Warren Buy in Asia, presented by our keynote speakers, Benny Zhu, CFA, Portfolio Manager for Matthews Asia, and Robert Hagstrom, CFA, Chief Investment Officer for Equity Compass. The discussion will be moderated by Damian Howard, who is CFA Nebraska's Vice President and Programming Chair. Damian, turn it over to you.
Thank you for coming, guys. Robert and Benny. I'm a GARP investor, growth investor, and just always wondered what led people to be value investors. What in your career made you warped to be a value investor?
Well, for me, I got started with my very first reading of anything of investing was a Berkshire Hathaway annual report. I was a trainee at a Legg Mason firm, Legg Mason Wood Walker, in Baltimore in 1983-84. And we went through value lines and stuff like that. And I heard people talking about you got to read the Intelligent Investor Security Analysis. I never read it, but the last night before our training program was over, it was a Berkshire Hathaway annual report. That was my indoctrination. And you got to remember in the 1980s, Warren was moving already to what you would call GARP. I'm not sure that's how I would think about it, but GARP being growth at a reasonable price. He was already moving that direction with Washington Post, Cap Cities, and Coke. So that was my indoctrination.
Benny?
Well, let me first answer what will Warren buy in Asia. Get that question out of the way. Well, obviously, I have no idea. No one knows what Warren would do. He keeps surprising the market just like what he did a few days ago. And what got me into value investing is I was in a completely different industry out of school. I was working at a software company called Oracle. And I was doing product management for their accounting ledger within Oracle ERP system. And I had no background in accounting or finance, had to really pick up accounting from a textbook. And then I needed to tell engineers how to code up the product. So from accounting, I started reading about Warren Buffett, starting from their Berkshire Hathaway's past annual shareholder letters, like a lot of you here in the room probably, and started drinking the Kool-Aid. That was back in 2002, 2003, 2005. And then I started looking for a job on the buy side in the mutual fund industry. And then luckily I found a job at a mutual fund shop. So I was trained as a value guy from day one, towards the end of 2005.
Okay. Can you guys describe your investment philosophy? Robert, someone told me you wrote about avoid putting outcomes over process and rational choice.
Well, the way that which we begin to think, if someone were to describe Warren's investment process or investment approach, we all gravitate to value, but he says right off the bat, everything intelligent about investing is going to have a value component. But if you really kind of think about Warren in the way that I think about it, I would coin the term business-driven investing. Every decision that he makes is from a business person's perspective, whether it is buying a wholly owned business at Berkshire, whether it's buying a common stock, whether it's lending money. Everything is done from a business perspective. And when you begin to wear that hat versus modern portfolio theory or standard asset allocation models and things like that, it's a totally different world, and your behavior is different and your thoughts are different. The one thing, though, that we do know is that from a business-driven investing process, it's a little bit more long-term. And your price performance is going to be variant as markets change and things like that. And the process versus outcome was a commentary I wrote for the London Value Conference coming up. And it just basically reminds you it's the process that's most important. The outcomes will come. Outcomes are variant. And if you're looking for outcomes first without understanding the process, you're going to be lost very soon, very quick. But if you've got a good process and the people understand your process, they can live with the variant outcomes over time. And that's what we try to preach.
Yep. Your investment philosophy.
Yeah, if you ask 10 people, 10 value investors in a room, you get 12 different answers how they define value. Now, when it comes to Asia, my value investing philosophy is really not much different from what probably Robert has in his mind. We're trying to find a good business, a business whose value will compound over time. We're focused on quality, but we want to buy that dollar at 70 cents, hoping that dollar's worth will continue to compound over time. And a lot of us are familiar with that approach, and it's actually not that much different from what Warren Buffett has been drifting towards in the past few decades. And I'm just using and deploying that approach to the region of Asia. And now the problem with Asia is you have to be very careful, right? The difference in practicing that kind of value investing in the region of Asia compared to more developed parts of the world in US and Europe is really corporate governance, right? Because undoubtedly, right, it is still a backward place when it comes to corporate governance. In the US, at least you trust that the board is going to do their job in protecting minority shareholders. And if they're not, guess what? With the increasing level of US activism, some US activists will knock on their door. But in Asia, that's a different story, because oftentimes you're running into either state-owned enterprises or more often family-owned businesses. So people always ask me, how do you trust the numbers that those Chinese companies report? And I'm sure a lot of you have heard about fraudulent cases that's being disclosed in China, at least every few months. My answer is, those financial numbers are nothing more than something that people write on a piece of paper, right? They can be completely manipulated and massaged. You have to trust the people. That's the bottom line. So part of our process, at least at the very initial stage, and by the way, that's where I spend probably majority of my time doing due diligence on a company, is just asking, can I trust that person, feeding me information? If the answer is no, if there's something fishy going on, either the business model is dodgy or the people, the family did not have a very clean history in dealing with minority shareholders, or there are some suspicious related party transactions between this listed company and other private companies under the same family empire, you don't even bother. I don't even bother to look at the financial statements. I don't care how cheap the share price is. You move on, right? I can be very selective. I own fewer than 40 names in the portfolio out of thousands of names of potential, names that I could potentially buy. So really, you have to be very careful about the people that you are dealing with in that part of the world.
So why even invest in Asia? Why not just invest in U.S. multinationals like CAT, General Motors, or Estee Lauder? Why go through that risk?
Yeah, so I started off my career at Artisan Partners, and I worked for their global value team. So I spent a lot of time looking at U.S. and European companies. In fact, my first company when I joined this industry was looking at Tyco, the company that was behind the huge accounting scandal in the late 90s. And that was year 2005. I believe 2006 it was broken into 3 different pieces. So my training or my apprenticeship back when I was at Artisan days was really looking at multinational companies, analyzing their growth drivers coming from Asia. And we bought a lot of businesses such as Nestle, Unilever, Reckitt Benckiser, those multinational companies that have meaningful exposure to Asia. And we bought them at, mid-teen times earnings, pretty, reasonable share price. And when you ask a lot of non-US global value money managers, one typical answer you hear back from them is, I don't need to bother with investing in Asian companies directly. I can access growth from Asia through Nestle, Procter & Gamble, Starbucks, or Nike. I think that statement was, and by the way, I think that's still a completely valid statement. But what I would argue from my biased perspective was that 5, 6, 7 years ago, that was a much more valid statement, because those multinational US companies was trading at a much lower multiple, 15, 16, 17 times earnings. Now today, all these multinational companies I just mentioned, all of them are trading at 25 or more than 25 times earnings. And when you look at their Asian counterpart, right, either in healthcare, in medical device, in consumer discretionary, in consumer staples, they are trading at a much lower multiple, yet growing at a much faster pace, well into double-digit rates. So now it starts to tilt, the equation starts to get tilted. When you have, on the one hand, multinational companies, top line barely growing, mid-single digit rate. And by the way, out of that mid-single digit growth rate, vast majority is driven by China, trading well over 25 times earnings. And on the other hand, you have these Asian counterparts growing well over double digit, trading at mid-teen times earnings. Now you start to, wonder whether we should, have direct access to Asia by investing directly in these Asian companies. I'm not saying that you should choose this side over this side. But at least we're starting to have a debate now.
Robert?
Well, we can
That
get into
and
this
also-
because I own Unilever, I own Nestle at 28 times earnings, and I think it's a great value. And Benny's got a good portfolio, and he's got a different game that I'm playing. I was talking to Brian, who's at Morningstar, and Brian worked at Holt, and one of the things that we were remembering is the work that is done on multiples. And Benny, with all great respect, multiples don't tell you anything about value. They're just a summation of what the economics of the business are. We bought Dell Computer at 45 times earnings, and the 1990s when I worked with Bill Miller made 8,000% on our portfolio. And everybody said we abandoned value and we didn't know what we were doing. Well, anything that goes up 8,000% in the decade of the 90s was mispriced even at 45 times earnings. At Benny's point, when you look at a Unilever and Nestle at 25 to 28 times, it does look expensive. But if you do think that they can do even high single digits, and that could last for 10 years, and the return on capital is above the cost of capital, by Michael Mobison's work, that thing could be worth maybe 40 times earnings because the market doesn't accurately price the sustainability of growth and high returns on capital. So even though 28 is above the market, it may be below what it's actually worth. And that's my game. I think the game in Asia, I think what Benny is doing is very, very good. He's got boots on the ground, and what he said was a Buffett-esque thing, which is you've got to know who the people are, and you've got to understand the candor and the trustworthiness because these people are pulling the trigger. That's absolutely essential. And when you talk to the big sovereign wealth funds who want to do emerging markets, they want guys like Benny that have boots on the ground. For our clients, though, to Benny's point, they don't want to own Asian companies just yet for the governance issues and things like that. So they're going to buy global multinationals. So half my portfolio is US, half is European. We own one Chinese company, Alibaba. Mm-hmm. But we own that because we understood Amazon. We did the IPO on Amazon when I worked with Bill, and we could understand that business model. But what you're making a bet on is the fact that this thing that's going on in the Southeast Asian markets is something that's the magnitude of it is, we've never seen this in our lifetime. McKinsey calls it the greatest growth story in the history of capitalism. When you think about 4 or 5 billion people moving to the middle class, that's a hell of a lot of Unilever soap they're going to be buying for the next 10 years. That's a lot of Nestle noodles that they're going to be buying for the next 10 years. And I'm happy to ride that wave that I think will be sustained over not just a few years. This is something that's going to happen 5, 10, 15 years. And I'll leave you with this. Benny will appreciate this. You know how we used to go to the Berkshire meeting, we'd wait for Charlie to give us what the book was that he was reading. We'd always wait. Well, now he doesn't do it. He actually orders the book ahead of time because when he tells you what the book is, everybody runs to the local bookstores and they don't have the book. So if you go to Bookworm, here's the trick. If you go to Bookworm or any of the local ones, on Monday when you come in or Tuesday, you can say, what's Charlie's book? They'll tell you. And guess what's Charlie's book this year? It's a great book, and I'm sure The Future is Asian is Charlie's book. It's a brilliant book, and it lays out this tidal wave of economic growth and middle class migration of billions and billions of people, and we're just riding that wave through multinationals.
So what do you think the biggest misconception is on investing in Asia that's out there, that your clients say?
Well, this is, Benny's much better in this. I think the two things I'm coming away for is that Asia is not China. It is China, but it's much, as Benny would tell you, Asia is, China is what, 1.5 billion, Benny? But then you add India is 1.3 billion, you add the 10 ASEAN economies that, 450 million, 500 million. You start to add it all up, and, there's 3-4 billion people that go from the, the Red Sea down through Southeast and into the China Sea. There's, it's 4 or 5 billion people, so it's much bigger than China. It is a huge populace of think about 5 billion people. That's 12 times as big as the European Union, right? No, 10 times bigger as the European Union, 12 times as big as all of North America, including US, Canada, and Mexico. The magnitude of this that's going on is, you'll never see this in your lifetime. And I'm lucky to be still 62 and be able to ride this, for another 10, 15 years. You'll never see anything like this again in your lifetime.
Benny?
Yeah, I would just mention 2 points regarding the misconception. Well, first of all, the misconception about China itself. I think China is so big and diverse and heterogeneous that oftentimes when I meet with management and they tell you, okay, our business is growing X percentage out of China, right? But there's vast difference between what's happening in the hinterland and what's happening on the eastern seaboard. And you really have to disaggregate that average figure down to what's happening in each top-tier places and second-tier cities and third-tier cities, because an average figure, that you learn from management from any company or any newspaper press is really meaningless, because the difference between Chengdu, the capital of Sichuan, and China is much bigger than the difference between Omaha and New York. So that's number one. Number two is, I think when it comes to doing value investing in Asia, the misconception is that line itself. How do you do value investing in Asia? People think that it's an oxymoron, right? Because Asian, as Robert mentioned, one of the fastest growing regions in the world, really once in a lifetime type of story. And of course, you should do growth investing, right? You should pay up. You should pay up 20, 30, 40, 50, 60 times earnings to buy a growth story and ride the multi-decade wave. Why do you bother? How can you even do value investing, right? That gets back to the biggest misperception that growth and value are really joined at the hip, right? It's really two sides of the same coin. We are not buying, a Chinese cement plant or steel plant at a fraction of its replacement cost, right? We're not buying a dying business or stagnant business at 3, 5, 6 times earnings. We want to buy Alibaba. We want to buy Tencent. We want to buy the dominant technology player or a really good, fast-growing medical device player, domestic player in China or in the rest of Asia. But we want to buy them when some bad news hitting the wire and share price is oversold. There's no reason why market dislocation cannot happen in Asia, right? People here, they sell first, ask questions later. People investing in Asia, they do exactly the same thing. We're very reactionary in that perspective. We wait for the bad news to happen, be patient, be opportunistic, and you come in, you assess the situation, and really ask yourself, is the share price oversold enough? If you have high conviction, you back up the truck. So, from my personal, again, biased perspective, I see no reason why you cannot practice that kind of value investing in Asia, because the market psychology is really the same in that part of the world.
One of the things with emerging markets is a lot of it, when the Fed cuts, emerging markets go up, Fed raises rates, emerging markets get killed. How much in your thinking and looking at, especially the emerging markets, non-Chinese markets and stuff, has to do with U.S. interest rates, U.S. policy, or is it company over the long haul looking at things?
No, I'm a 100% bottom-up stock picker. And I'm cognizant of those macro factors. Whatever the U.S. Fed is doing, obviously, it has an impact on the market. But I really treat them on a day-to-day basis as just nothing more than noise. They create opportunities for me if some share price gets slaughtered because of some macro-level noise. And for me, it's very much something that I take advantage of. They're not really part of my investment process or drive my stock picking, the selection process in Asia.
Robert, how much does the Fed's latest burp or iteration?
It wouldn't change. To Benny's point, it wouldn't change what we would do. But having said that, the health of emerging markets are much better today than were in 1998. If you look at the balance sheet of emerging markets in 1998, it was almost 85% dollar-denominated debt. And so when interest rates went up, they got killed. Today, on an average basis, dollar-denominated debt in most of the emerging markets in the ASEAN economy is probably 30%. So the changing impact of interest rates on their economies and currencies are nowhere near what it was in the Asian financial crisis of '98. It's a totally different game now.
Okay, can you, Benny, we put this up, your process on the ground. Just walk through, when you look at a company in Asia, boots on the ground, why does it make a difference versus buying an index in China?
So before I came, I was told I can present just one slide. And I was like, just one slide. Wow, that's
At least
really
you
a
got to
tough
present a
task.
slide. I couldn't even bring
Yeah,
a slide.
where's your slide, Robert? So I actually picked this slide that I used internally. So I didn't create this slide for any external audience. This is a trip debriefing slide I presented to the internal investment team just a month ago. It's really the 4 highlights out of my March trip. I want to tell people, I put up this slide because really I think it's a bit unique. I really want to go into maybe a little bit depth, walking you through what I actually did on the ground during my March trip, March the 11th, Monday through March the 22nd, Friday. I went to Shanghai, Tokyo, and Osaka, went to 2 countries. And I went to visit, so I removed the company names for compliance reasons, but I can speak to it now. I went to Yum China's Investor Day in Shanghai. Yum China was spun off from the US Yum parent a few years ago, also got listed in the US here. Before the spin-off, Yum China's profit contribution is close to half of their US parent's total contribution. And they held their Investor Day on March the 12th. And as you can see, it was a dog and pony show, right? Just like a lot of the management meetings I've been to, they only tell you promotional stuff, and they only tell you the good part of their story. They try to hide the bad part. And so it was not very insightful, but I still keep going back to these investor days for a couple of reasons. One is it's a very rare opportunity for me to immerse myself thinking about nothing but that business for a day or 2. And second reason is the main insights I typically get out of those investor days is never from those staged presentations from C-level executives. It's those, side chats, one-on-one chats I get to have, from a casual lunch, from the cocktail hours, that I get to have from their head of sales, head of marketing, head of R&D, those people that investors normally do not have access to. It's those opportunities where I can really glean, a lot of insights. That's the reason I keep going back to these investor days. But this investor day, unfortunately, didn't really provide me with that opportunity. And then we went to Japan, went to Tokyo and Osaka, visited about 15 companies, and I ended up pulling the trigger on one of the companies that we met with in Osaka. It was a very fruitful trip. A lot of trips we went there, I ended up not pulling any trigger. But this time we met with a company in Osaka doing recruiting services, and they specifically target graduating college seniors and people in their 20s that are looking to change their jobs. And as you know, because of the demographics in Japan, there is increasing shortage of labor. So they're really in the sweet spot. But their top line didn't really grow along with the rest of the industry. Well, their top line did grow. Their bottom line didn't grow along with the rest of the industry last year because they really launched a national TV campaign. So that, I believe, temporarily depressed their bottom line profit last year. So that gave me an opportunity to pick up their shares at a pretty undervalued valuation multiple. So, and then I went to Nanjing. I'm sorry, I was at the industry trade show. I went to an industry trade show in Shanghai. And I normally hate going to these investor conferences because these investor conferences where they hold you up in a hotel room meeting with IRs or CEOs, CFOs, most of them are dog and pony shows, right? You don't really get much out of it. They tell all the investors the same script, very promotional, very biased, very rosy picture. The due diligence avenues I like to go to are these industry trade shows where companies will set up booths and typically trying to introduce their new products and oftentimes a place for them to sign deals. So I went to this laser and optics trade show in Shanghai for 2 days, and it was just over-the-top experience for me to talk to. None of the people I talked to are C-level people or IR officers, right? I ended up talking to salespeople, marketing people, R&D people. I would walk into a company booth and just ask them, hey, your competitor is a few booths away and they just launched this new product. What do you think, right? This competitor just got a new CEO half a year ago, and he seems to be pretty aggressive, trying to turn around the business. Are you guys feeling any impact on the ground? So it's really, I call it LinkedIn on steroid, right? You just have access to a lot of industry people in one fell swoop. My last stop was in Nanjing, just an hour high-speed train ride away from Shanghai. And I went to visit, this was an interesting meeting. I went to visit a US company's headquarters in China. A.O. Smith, you guys have heard of this company? A.O. Smith, they're the biggest water heater players in the US, headquartered in Milwaukee. Their top line is a bit over $3 billion US dollars. Now, little do people know that over 1/3 of that $3 billion comes out of China. They've built a thriving Chinese business. I've admired this business in a distance for a long time, always wanted to go visit them. I contacted their people early this year, and luckily they let me go visit their China headquarters this time. I met with their China president for 3.5 hours. It ended with a lunch in their canteen. At the end of that 3.5 hour visit, their China president told me, this has to be the most thorough investor meetings I've ever had. Out of all those, US-based investors that came to visit us, I was like, oh, that's interesting. Why is that? Well, you came by, all you wanted to know is corporate culture, DNA, history, incentives, KPIs. You asked me nothing about, what do you think about the China macro slowdown in the second half of 18? What do you think that your top line will grow? Can you tell me your margin, right? What do you think about the channel shift from online to offline? You didn't ask me any of that. All you wanted to know is just to hear some stories about how we've evolved, right? As a company, as a U.S. Overseas subsidiary over the past 20 years. It's just a very refreshing conversation. And I wrote here, culture eats strategy. What I've learned is it's really their strong culture over the past 20 years that allowed them to beat very aggressive Chinese competitors. And I was very impressed. Even though this is a growth idea, it's trading at 20 times earnings, it's still beyond my comfort zone when it comes to valuation. It's on my watch list. One quarter, they might have a profit warning. I'll be able to pick it up. So I just want to give you a very, maybe a bit concrete flavor what one of these on-the-ground research trip looks like.
Yep. But as I said, I salute Benny, because if you're going to buy the emerging market stocks, having Benny on the ground is your competitive advantage. I would also say that the securities laws in the emerging markets are not as stringent to have one-off conversations. With Reg FD, it's become a waste of time to do a hit in the U.S. Even when you go to trade shows here in the U.S., everybody's scripted. They're not going to say anything that's not already been approved by their internal legal team. But so they have a lot more flexibility to talk about things, off the cuff, of which Benny's intel will give him a great deal of insight. So he's doing exactly the right thing, and he's figuring out where the mispricing is by doing that type of intelligent research and boots on the ground, and it'll work very well for him.
Right. One of the things, Asia is the largest market for automobiles, and the future for, most people tell me the future for automobiles is electric vehicles. What do you see in Asia electric vehicles? I'm sure you've looked at some. And Warren's got a investment in electric vehicles. And
Yeah, you want to start?
I've never owned an automobile manufacturer in my life. One of the economists told me that there were 20 worldwide automobile manufacturers that make 300 makes and models a year. That's the commodity business in my mind. I've never owned it. Having said that, McKinsey's got a brilliant report out about what's going to happen, the disruptive effect of not only electrified cars, but autonomous cars. And I would tell you there's going to be a massive amount of disruption widely occurring throughout the economies, globally speaking, when electrification and autonomous begins to S-curve up. I don't know what Benny's view is.
No, I don't think I have anything or much to add to that. China obviously accounts for majority of the EVs sold in the world today. As I do own one global EV battery player in the space, but that's not because I'm ultra bullish on EV. It's just because I can get that EV battery business for free. Then I don't, if that's the case, I don't really have to agonize over what percentage of the global auto fleet will be hybrids or EVs by 2020, 2025. A lot of my growth fellows on my team, they really have to agonize. What's the growth trajectory like for EVs over the next 10, 20 years. But if I can get one of the world's leading EV battery business for free, I don't have to agonize over that. I guess that's the beauty of being a value investor. When you are not paying much for that business, you don't have to agonize over a lot of things.
When I mention Asia investing, 99% of people would say China or maybe Japan. But there's more to Asia than China and Japan. What do you see about the non-Chinese countries?
Yeah. So let's take India as an example, right? I currently have pretty much close to zero exposure to India. Not because I'm not interested in India. And in fact, I continue to pay attention to some of the best run Indian businesses in the world. For example, last week just met with the CEO of HDFC Bank, which a lot of you know is one of the best run banks in the world. But they were trading at 4 times book, 20% ROE, 20 times earnings, a fantastically run business. And one could argue that it is still undervalued. But I think overall that market is pretty expensive for me, trading close to 20 times forward earnings. And I continue to do my homework, and one day I'm quite certain that market will have a major correction. And hopefully by then I'll have my homework done. I don't have to scramble to pick up some bargains.
What do you see about?
Well, we don't own Indian stocks, but we sell a hell of a lot of product in India.
Yeah.
Unilever, and back to Unilever, the world's largest selling soap in the world is Lifebuoy. Remember Lifebuoy, that green soap? I used to, my dad would give it to me when I go to camp, and he said at the end of the 4 weeks, you better have that bar down to this. You would take a shower every day, that bar never moves. I mean, you'd come back. I mean, it'd be 3 days before my dad would pick up, and I'm like trying to get the bar down, right? We sell a hell of a lot of Lifebuoy soap in India. And so we have that benefit through our multinationals of selling a lot of products, consumer products and others into India. And I would point out, I think the most unrecognized opportunity that's growing faster than India and faster in China is the ASEAN economies, 10 Southeast. I mean, you got Brunei, Myanmar, Malaysia, Indonesia, Thailand, Laos, Vietnam, Cambodia, Philippines, and Singapore. That's close to 500 million people, and they're 7.5% growth. And their purchasing power parity is much more rapid than India growth. That's a really sweet spot, and we've got a lot of business down there.
I'll pause and see if there's any questions from the floor.
Thanks. You had brought up the point that corporate governance is a big issue in Asia. What signs have you seen of that improving over time? And do you see it improving? And I guess I'm assuming that it is, otherwise you wouldn't be investing there. But where have you seen it improve, and maybe where does it still have a long ways to go?
Right.
And also give a kind of example of where it's gone wrong.
Right. So I would just single out countries such as Korea and Japan, where you've clearly seen improving trends in corporate governance, especially in the area of returning cash to shareholders. For both countries, their dividend payout ratio used to be very pathetic. Well, they're still not great, but clearly you've seen that under minority shareholders' pressure and also under government's pressure. The Japanese government has started to publish corporate governance codes for Japan Inc., and you've seen both countries really gradually improving their payout ratio to shareholders. And also for a country like Japan, they've been a lot of Japanese companies have been a lot more aggressive in buying back their shares. So on that front, you've seen really visible improvement in how they treat minority shareholders in the cash return front. I think it will still take a lot of time. It's a 2 steps forward, 1 step backward sort of process. You've all seen the U.S. activist Elliott, what they've been doing to Samsung Electronics 2 years ago, and Hyundai Motor Group as we speak. So you can see that as more and more foreign capital are participating in that part of the world, a lot of local managements are under increasing pressure to be more transparent, to be held accountable, and to return more cash to shareholders. I think that's definitely happening. But the trend, but the improving trend, I'm sure, is still slower than a lot of us would desire to see.
Yeah, the observation that we have is that corporate governance is actually accelerating more in the ASEAN economies than it is in China. If you can just tell that by the foreign direct investment, the ASEAN economies each year are getting more foreign direct investment into those markets than China is. So they're doing a much better job on governance. Having said that, I think China will not let this opportunity get away that they're not going to have 3, 4, 5 of some of the world's largest market cap stocks. I mean, they're going to be one of the top 1, 2 market cap stock markets in the world, and not to have an equivalent 1, 2, 3 top companies in the world doesn't make sense to me. And in order for that to happen, I think it's in their self-interest to continue to work on governance and transparency, because that drives foreign direct investment. And as I said, it's happening in the ASEAN economies. They're getting more money than China because their governance is better.
Stacy, I think we had a question up here.
Greg Warren, Morningstar. Just a quick sort of two-parter almost. With BYD, do you have a feel for management culture there? And then to follow on with sort of the Warren Buffett scenario.
Yeah.
I mean, he's been investing in that for over 10 years, but not really invested much beyond that in China, specifically in the Asia-Pacific region overall.
Yeah.
Do you think part of that's because of the problem he has with culture, or is it more the problem that Berkshire is more of a pull model than a push model? He and Charlie are waiting for somebody to call them as opposed to having boots on the ground.
Yeah. I haven't taken a really close look at BYD in the sense that I haven't really done a deep dive into BYD's numbers, and I've only met with them once or twice over the past 10 years. But I can tell you, based on everything I've read, the interviews that in Chinese I've read with their founder Wang Chuanfu, I think that Wang Chuanfu himself I really like the guy. He's a very visionary guy. I can totally see why Warren Buffett and Charlie Munger decided to invest in this little unknown company in 2008, more than 10 years ago. Now, but again, I don't know what their internal corporate culture is like. I cannot answer your question directly. And with respect to why Warren Buffett hasn't really made any other sizable investments other than BYD, I don't think it's a Chinese culture issue, right? It really comes down to the corporate culture.
I was thinking more culture meshed with Berkshire.
Yeah, right. But BYD, I think that's a minority, passive investment. I don't see why he cannot make other such passive minority investment. So I don't see a perfect culture mesh between the Chinese investee and Berkshire Hathaway to be a major obstacle. I think it's just hard for him to find a big one, an elephant, that will move the needle for him. That would be my guess. Yeah.
Well, BYD isn't Warren, that's Charlie. And so my guess is if Charlie wouldn't have bought it, Warren wouldn't have owned it. So that wasn't a Warren bet, that was a Charlie bet.
Yeah.
I would tell you personally, one of my biggest frustrations is why he hasn't moved more internationally. When he did when 3G took Kraft Heinz after Unilever, it kind of gave you that glimmer like, oh, he finally gets it. But now being a Unilever shareholder, I was really grateful that they didn't buy it, because I didn't want Kraft Heinz, which has 80% of its business in developed markets, and Unilever has 60% of it in emerging. I know why Kraft Heinz wants Unilever, and I wish he would have just bought Unilever without pairing it with Kraft Heinz. But I'd love for you to ask the question, like, when are we going to move the needle internationally? Now, are they waiting for somebody to call him? Well, Tim Cook didn't call him on Apple. He finally figured out Apple, and it wasn't because he figured out technology. Apple. The description of Apple is not technology. A lot of people said, well, is that Motorola and Nokia? How does this work out? Apple's not Motorola and Nokia. Apple's Louis Vuitton. And when you kind of figured that out, he got very comfortable with that. And so I don't think there's any reason why he shouldn't be going after these larger European multinationals. There's plenty of room to put money to work. If he wants to put 10, 20 billion, these guys have got plenty of room to put that to work.
Okay.
Ask him tomorrow, would you?
We're just going to ask Benny, how do you value state-owned enterprises, and particularly Chinese banks, State Bank of India, some of those? How do you put that in a valuation framework?
That's a good question. I I don't know how to value Chinese banks, and that's why those Chinese banks, they've just in recent years, they traded at 5, 6, 7, 8 times earnings, right? They were clearly screaming value buys from a casual observer's perspective, and I have a bias on those Chinese banks, very simple, and I look at them nothing more than government policy tools, pure and simple, and that's why I never touch them. And now on the more general question, how I value state-owned enterprises, you take that into account, and so that I personally would demand it's not a strict no. I don't categorically say no to state-owned enterprises. There's pretty good durable franchises in China owned by either central governments or municipal government. I own a Chinese liquor company owned by a provincial government. It's a case by case. I do own at this point in the value fund, I own China Mobile, right, the dominant mobile operator. And they're owned, it's a strategic asset, as you can imagine, owned by the central government. They have 60% market share in China in the mobile space. I pulled the trigger because its valuation came down to so low that I can live with the fact that it is a state-owned enterprise. And the payout ratio, am I happy with the payout ratio? No, their payout ratio is 50%. They should pay out 80%, right? You hardly get an investment where you get a score of 5 on every single metric. There's always trade-offs that you have to do. On a state-owned company like China Mobile, if I want to get involved, then I wanted to get involved when the valuation was dirt cheap. And I bought it when the valuation was EV over EBITDA at 2.5 times. You know, when I breached that level, I pulled the trigger. So it's really a case-by-case thing when it comes to state-owned enterprises.
I have no idea how to value banks, Chinese or American, and my therapist strongly recommended that since 2008 I not try it again.
Okay. We'll get in one political thing. Was President Trump justified in starting the trade skirmish with IP issues and forced transfer and everything else? What's your take on that?
I can't remember how Nebraska voted. How did?
Oh,
Is this a blue state or a red state?
red.
I have to remember. I have the yellow tie, which means I don't know if it's blue or red. I wear the yellow. Being a globalist, I could tell you I'm not in favor of trade wars. Markets don't like trade wars. Companies don't like trade wars. It's very hard to figure out how to run your business when you've got trade friction out there. Let's just get on the record. Nobody held a gun on us in 1992 when China went into the WTO and said, if you want to come into our country and sell your product, these are the terms of the deal. And we said, sure, we'll do this. Now what happened is 10, 15, 20 years later, as their economy is booming and ours is not, we want to redo the deal. We have every right to redo the deal. And that's what they're trying to figure out. But make no mistake, they didn't hold a gun and said, you got to do this. We said, sure, we'll build a building in Shanghai if you let us sell products in here. And yes, we'll let you partner with us if you can let us sell products in here. So that was the deal, Greg, 20 years ago. Now we want to redo the deal, and that's what they're trying. I'm not encouraged with the negotiations thus far, and you can only look at the USMCA agreement, which is nothing. If you read that, which I did, I can't figure out what they argued about for 6 months. The best I can tell is we're basically going to sell a little bit more milk to Canada, and Mexico is going to sell a few more cars at labor prices at $15 an hour. Past that, I don't know what was different than NAFTA and USMCA. So I'm not sure this thing is working out as well as I would like. Now, show of hands, this would be great. How many of you think the market has already priced in a good China agreement? Okay, so unless it's going to be really, really, really good, I think the market's already got this one. Second thing is Congress is not going to pass the USMCA deal as it stands now, so that doesn't get passed. Whether they'll pass the China deal, I don't know if that gets passed, they'll look at the terms. And by the way, once we get done with China in a few weeks or a few months, whatever, we're going to do Japan. Then we got to get that one done. And then guess who's next? Europe. So we're in this for a couple of years, and if you look at the history of trade, it goes like this. You go through 2 or 3 years about every couple of decades where everybody gets mad and wants to redo the deal, and we're in the middle of it. But I'm not hugely optimistic that on the other side of this it's going to be happy days. I just don't see it.
Yeah, well, for a bottom-up stock picker like me, you know, what happened over the past half a year, especially towards the end of 2018, was very much good news, because I was able to take advantage of a lot of the undervalued opportunities caused by this U.S.-China trade war noise. And I think, you know, when you look at it from the macro perspective, I think the leaders from both sides are very pragmatic. Both wants a deal to get done. And a deal for sure will be put on the table within the next month or so, with very high probability. The more tricky part is how are you going to enforce that deal, right? I think the Chinese have a lot of ways to skirt the rules. That's the reality. You know, it will be very hard for the U.S. to monitor that. And even the bigger question is, whatever deal that they're going to come up with, in my opinion, is nothing going to be a short-term band-aid, right? It's not going to resolve the underlying structural bilateral relations between the two countries. This strategic rivalry between an incumbent power versus a rising power, as we've seen over and over again in history, that rivalry is going to stay for many, many years to come. I'm just hoping that there will be no accidental escalation on the military front coming out of the China South Sea. You know, barring those extraordinary circumstances, I believe the two countries will figure out and maneuver around, you know, live in a somewhat peaceful manner while still competing with each other right beneath the surface, without, you know, outright confrontation. But, you know, this will stay with us for a long time to come.
Any other?
Let me just add one more thing. If you read the last McKinsey quarterly that came out, they said something that I did not quite calculate really well, is that just in the last 18 months, they're seeing that trade is accelerating amongst the regional economies in Southeast Asia amongst themselves, and more so with developed countries. And if you think about it, when you read this book, The Future is Asian, you've got an ecosystem of 5 billion people that are going to figure out how to trade amongst themselves, and therefore, you know, I'm wondering if we're fighting a war that's, you know, we need to be going ahead, not backwards. And they're already moving. They're already moving and they're trading with each other in Southeast Asia like bandits. And it's a free trade zone down there. And that trade is growing, and ours is not. And it's because of all this bickering and tariffs and stuff like that. So I'm wondering, you know, are we fighting yesterday's war? This thing is already moving past us at lightning speed. That's a concern.
Any other questions from the floor?
So I just wanted to add to Robert's point. Yeah, so there's increasing amount of trade intra-Asia. I went to Vietnam twice last year, and I was just amazed. Vietnam was very much like China was 20 years ago. You can just feel the hustle and bustle on the street. And as wage keeps increasing in China, you just see a lot of businesses moving their factories down to Vietnam. I think when you look at the macro stat, I was amazed to see, I can't remember the exact number, but 1/3, or 25 to 1/3 of the export out of Vietnam is Samsung Electronics products, and most of that is mobile phones, because Samsung has built a huge factory complex there. So Matthews overall, we're really adding our exposure to ASEAN countries like Vietnam, which obviously is actually an accidental beneficiary of this U.S.-China trade dispute.
I agree.
Right. Any questions from the floor? If not, I have some more. Okay. One of the things that I asked my analyst is what can go wrong? What's my downside?
Well, you know, I don't really worry about Warren said, you know, last year so brilliantly, he's been doing it since he bought City Services preferred in '42, and there have been 7 Republicans and 7 Democrats. He's gone through Cold Wars, political assassinations, hyperinflation, you name it, and you kind of think, well, okay, if he could do that, we could do that. I mean, I think, you know, his worry was always, you know, nuclear, biological, cyber attacks that could severely disrupt the system. That's always, you know, the thing that's in the back of your mind. You know, for me personally, I'm just puzzled about the debt levels and how the markets don't seem to care about it. And I don't know what this MMT thing is. I got to figure that one out. But we gave out Nobel Prizes to Milton Friedman and the other monitors that said if we printed this much debt, we're supposed to have very high inflation and higher interest rates. Well, somebody needs to go dig that up and get the Nobel Prize back, because that's not happening. Even in Japan, where it's 200% debt to GDP, I can't figure that one out. So Randall Forsythe wrote a very interesting column in Barron's. He said, you know, it doesn't matter until it matters. And maybe that's where we are, which is we know it's a problem, but we don't really care about it, and we're going to continue to go on. But you get a sense that one day this is going to matter, right, the debt levels. And when it does matter, it could be a problem. That bothers me.
I just worry about the increasing geopolitical tensions in the South China Sea, as I mentioned. Hopefully there will be no accidents happening in that region.
Just a question from the floor.
So Benny, question for you. You know, cannabis is becoming more global in the economy and what we're looking at. I mean, do you see China legalizing cannabis? And I guess for you, a Unilever, I mean, Nelson Peltz is on the board with Trion Fund, hedge fund. What do you think about that? What's your take?
Yeah,
well, I mean, we're talking about technology products and everything else. What about some of these commodities?
That's a hard question for me to answer, because I've actually never looked at that industry in China. I just read an article a few days ago that apparently it's a booming industry in China, although I haven't seen any listed companies or even pre-IPO companies in that space yet. So I haven't really, you know, done much work in that space.
You know, I always end up with, what question didn't I ask that I should have asked?
Well, the one thing that I would point out that Benny and I were talking about, and even though we're playing the same game and attacking it slightly differently, we have exactly the same portfolio composition. You're running 30 stocks with a 30% turnover ratio, so he holding it 3 years plus. I have 25 stocks and, you know, 8 to 10% turnover ratio. And I would tell you that, as Bill Miller used to say, it's not that active management doesn't work, it's the strategies used by most active managers that doesn't work. And if you look at the bell curve of Morningstar, you can look them up, you know, the average number of stocks in portfolios is 100 plus. The average turnover ratio for portfolios is 100 plus. And then you add cost and management fees and you wonder how they can't beat the market. Well, they're not designed. So financial analysts have done a great job, CFA Society, that tells you high active share portfolios, Benny's portfolio, low turnover portfolios, Benny's portfolio, stock picker portfolios, Benny's portfolio, do beat the market. The problem that you have is, and Benny, I apologize, but the frequency of the outperformance of high active shares is variant. You know, I'm ahead of the MSCI All Country World for the last 5 years. My batting average is 50-50 on a quarterly basis, which means I'm outperforming half the time and underperforming half the time. But when you do this, it's not frequency, it's magnitude. It's not how many times you're right, less how many times you're wrong. It's how much money you make when you're right, less how much money you give back when you're wrong. But then you got to tell the client, well, when we underperform for the quarter, it's not because Robert's an idiot. It's just because he's got a static portfolio and the market varies around it. Look at what he owns and what the economics are. But we're attacking from a portfolio composition exactly the same way. And when you think about active management, I would put that high on your list, that as the CFA Journal and Kremers and Petajusta point out, high active share is the most optimal way for a portfolio manager to beat the market.
And explain high active share to our lay people here.
Well, Warren, when we did the Warren Buffett portfolio, Warren called it focus investing. So, you know, Warren and Charlie and John Maynard Keynes and Lou Simpson and the Sequoia Fund and on, you know, had these, you know, very tight portfolios. Now Kremers and Petajusta have termed it high active share. So if you have zero in common with your index, you have, you know, I would say it this way. If you have 100% of your portfolio looks like 100% of the market, you have identical. So the degree that you're different from it, that will drive you high active share. So what you want to do is you can measure the difference. I'm surprised you guys aren't doing this yet, which is you should be telling everybody what is the active share percent of the portfolio relative to their benchmark for them to judge how different you are. I would think that Morningstar would want to do that. And to the degree that you have high active share means that you're much different than what the underlying portfolio is. And that's the key to outperformance. Now, the problem with high active share portfolios, it increases the likelihood that you can beat the market, but it also increases the likelihood that you're going to underperform the market. And the key variable is, do you have Benny on the ground making the decisions about what stocks to buy? Because it becomes a stock picker portfolio, and that's where the rubber hits the road.
Benny, what would you like to, didn't I ask that I should have?
Well, first of all, I would like to echo Robert's point, right? If you ask me, I think 38 names is too many in my portfolio. I wish, because obviously I run a mutual fund, which is subject to the U.S. SEC rule for a diversified mutual fund. There's a certain limit I can, beyond which I cannot concentrate the portfolio further down to. But the question that I wish somebody asked me is, how do I think about technology shares, right? Because that's really one of the biggest reasons why a lot of orthodox value money managers have underperformed the market in recent years. And I sometimes get this question from clients, given your technology background, what do you think about investing in Tencent, Alibaba of the world in Asia? And my answer is, I don't like to tell people my philosophical thinking. I tell them what I've actually done. And I was on the sideline for many years on these major technology powerhouses in Asia for valuation concerns. Until the second half of last year, I started to pull the trigger on some of the very well-known names in Asia. And I bought one at 15 times earnings ex cash. I bought the other at 12 times earnings ex cash. And they each has dominant market share in their respective country. And if I can buy them at low higher than mid-teen PE, that seems pretty compelling for me. And each one of them has at least 5 to 10 years of growth runway ahead of them. My point is, you just have to be patient. You have to be opportunistic. I'm not doing anything different with the technology sector. I feel very comfortable, given my background, analyzing these technology shares. I just have to wait for the right entry point to happen. And then really back on my truck. And these two positions combined, it's now close to 10% of the fund. A year ago, obviously, it was 0. Yeah.
Are there any investment opportunities with the Belt and Road Initiative? Does that lead to any investment opportunities for you?
No, I don't. As I mentioned, these macro policies never drove my investment process. I never woke up one day thinking, oh, geez, this sounds like a great initiative. Let me look for a name, on this 1B1R or OBOR, One Belt, One Road initiative. No, I never think along that line.
What do you think the biggest investor hesitation to adding more into Asian stocks or Asian investments?
Language barrier and lack of trust for numbers, really. I think these are probably the two biggest obstacles.
Well, it's home country bias, it's a behavioral aspect. People just buy what they're familiar with and what they understand, and that what you're not familiar with and you don't understand, you avoid. Europeans are much better at that than we are, because they learned it, 2 centuries ago, that their countries were very small, and if they wanted to prosper, they had to trade with different people. So they're not as phobic about home country bias as we are.
Well, speaking of home country bias, I have the opposite problem, because I grew up in China. I'm a Chinese national. I underweight China these days. If anything, I would overweight China, given my, given the home country bias. But for various reasons, there's just fewer opportunities I can find in China, primarily given my concern on the corporate governance front, even though there's lots of cheap stocks available in China.
Now, as a derivative of Asia, it seems to be that Europe is now seemingly more closely linked to Asia than they are to the U.S. now, as far as marginal growth and stuff. And if Asia picks up and stuff, you probably won't be able to. But is there European investments that you can invest in that will pick up due to Asia picking up? Faster growth in China versus, for instance, dollar renminbi and stuff like that. What's your thoughts, even though you're in Asia focused?
European multinational companies?
European companies that have exposure to Asia that you run across.
I think it's all fair game, right? It's like, you know, in the U.S., I could identify companies like A.O. Smith I could potentially buy one day. And, you know, there's companies like Danone oh, right, all those European, yeah, I forgot, a big category. All those Hermes, Richemont, Cartier, right? LVMH, that's a big category. And for all those companies, half of their earnings is coming from the Greater China region, including those goods bought by Chinese overseas. You know, I've owned Richemont in the past in the value fund. So yeah, so it's you know, it's all bottom up. If there's a good European company that's doing well in Asia, I can get it at the right price, I will be interested.
Yeah, we've owned Richemont for years.
Yeah.
We've owned Louis Vuitton for years. We've
Yeah.
owned Estee Lauder for years. We own L'Oreal through Nestle. You know, you already know exactly what the buying behavior of the Asian consumer, because it's identical to the buying behavior of the baby boom generation post World War II. The first thing that happened with discretionary income post World War II is you bought better tasting food. The second is you bought better tasting liquor. The third thing is you bought beauty care and health care products and things to clean the house. Fourth was you bought a camera, but today it's not a camera, it's a cell phone. Fifth was you traveled. I did in a country squire wagon going to Florida. In Asia, they get on a Boeing airplane and travel all around. You already know what the buying habits are going to be. You just got to line up the companies that are going to benefit from the buying habits that we already know are going to happen. I think luxury goods is a home run for this reason. There are not that many premium luxury global brand providers out there that are now facing billions of people, now the top 1% of that are going to be buying their product. The second thing is in Asia, they buy it as a stored value. It's not some, Asians are very, Benny would tell you, they do like to own luxury good items and show them, but they're also a store value, which is if you're thinking about moving money and you need to move money out of the country and move it separately, it's easier to do it with a watch or a Louis Vuitton bag or jewelry. And so not only is it a prestige thing, it's a stored value. So there's going to be huge demand for luxury good items, both soft leather, jewelry, and diamonds for many, many years to come. And there's just not that many players that do it. So I'm a big believer.
You know, I could possibly convince my wife buying a Chinese smartphone over Apple. I could never convince her, hey, here's a Chinese luxury brand that you should consider over Louis Vuitton. You know, there's no way.
Doesn't happen.
Or Borsheim. Yeah. Any other questions from the audience? If not, I'd like to thank our guests for coming here, and thank you.
Thanks, Dave.